All right, let's jump right into this explainer. Today, we're unpacking the brilliant, completely rule-breaking strategy of a $250 billion retail titan. We're talking about a company that has fundamentally flipped the script on how to make money, outperforming the market for decades, all while doing the exact opposite of what traditional business logic tells you to do.
Okay, let's dive into this because this right here is the ultimate retail paradox. If you think about traditional stores, their core objective is totally straightforward. Buy a product for as little as possible and sell it to you for as much as you're willing to pay. But Costco? They built a massive global empire by essentially refusing to profit from the actual goods they place in your shopping cart. You see, traditional retail is kind of adversarial, right? The store wants that 25 to 35% markup, meaning their financial interest is directly opposing yours. Costco completely rejects this. They enforce an ironclad discipline, specifically a hard cap on margins at roughly 14% for brand names and 15% for their private label. Even when Costco's buyers negotiate a way better deal with a supplier, they don't pocket that extra margin as easy profit. No, they pass every single cent of those savings directly back to the customer. And that strict commitment leads us to what Costco literally calls their sacred items. You probably know exactly what these numbers mean. $1.50 for the famous hot dog and soda combo, and $4.99 for their legendary rotisserie chicken. Costco actually sells over 137 million of these chickens annually. But here's the kicker. They do it at an estimated $30 to $40 million loss every single year. They willingly bleed money on these items just to prove their undeniable value to their members. They protect that pricing reputation so fiercely. There's this famous story about Costco's co-founder, Jim Sinegal. When the current CEO once complained that the company was losing its shirt on the $1.50 hot dog and suggested raising the price, Sinegal's response was legendary. He looked at him and said, "If you raise the price of the hot dog, I will kill you. Figure it out." They will protect that price point no matter what. So you gotta wonder, how do they actually survive? Section 1. The reveal. The membership profit engine. Now, what's really interesting here is that those incredibly slim 12 to 14% product margins basically just cover the massive costs of keeping the warehouse lights on and paying the staff. The true profit engine of Costco is the membership fee. Roughly 70% of their entire operating profit comes directly from the fees you pay just to walk through the front doors. To put that into perspective, in 2023 alone, those membership fees generated over $4.6 billion in revenue. Just think about the brilliance of this for a second. It costs Costco almost nothing to service a membership card. There's virtually zero marginal cost. So out of that $8.5 billion in total pre-tax income they generated that year, a massive chunk of it was pure, unadulterated profit from membership renewals. This creates an absolutely beautiful, perfectly aligned incentive loop. Step 1, you charge an upfront membership fee. Step 2, because you have that fee revenue locked in, you can price all your products at near cost, which creates massive, undeniable value. Step 3, the members realize they're saving an absolute fortune, so they happily renew their membership every single year. Costco's only job is to deliver value, completely aligning their financial success with your desire to save money. Section 2, the strategy of less operational brilliance and constraint. Now, to support this crazy aggressive pricing, Costco embraces something incredibly unnatural for a giant retailer: significantly less choice. Think about the SKU count, the number of individual items on the shelves. A typical Walmart carries around 120,000 items. Amazon literally has millions. Costco, just 3,700. This intense constraint isn't a limitation at all. It is a highly calculated, lethal strategic weapon. Because they limit it to just 3,700 items, they guarantee massive sales volume per item. That gives them unbelievable negotiating leverage with their suppliers. Plus, it entirely eradicates customer decision paralysis and allows for ultra-fast 30-day inventory turnover right off the original shipping pallets. It is just remarkably efficient. But what happens if the national brands flat out refuse to play ball on pricing? Well, Costco has a $75 billion ace up its sleeve. That is the annual sales figure for Costco's private label, Kirkland Signature. By engineering products to match or even beat national brands on quality while being 20 to 40% cheaper, Kirkland creates massive leverage. If it were an independent company, Kirkland would actually be bigger than Nike or Coca-Cola. It forces national brands to keep their prices rock bottom just to maintain their shelf space. Now, you might be wondering, wouldn't a limited selection get kind of boring? And that is exactly where the treasure hunt comes in. Costco deliberately dedicates about 25% of its warehouse inventory to unpredictable, rotating, limited-time offerings.
One day it's a giant teddy bear, the next it's a designer jacket or an opportunistic palette of electronics. This brilliantly transforms a routine, boring grocery run into an addictive experience. It creates incredible urgency. You gotta buy it now because it might be gone tomorrow, which drives up basket sizes and keeps members visiting constantly. Section 3. The Human Capital's Secret. The Good Jobs Advantage. This brings us to arguably the most counterintuitive part of their whole model. At a time when traditional retail views labor entirely as an annoying expense to be minimized, Costco makes a massive investment in its frontline human capital. Co-founder Jim Sinegal championed this philosophy from day one, famously stating, "Paying workers well is not just altruism, it's good business." And he really practiced what he preached. For many years, Sinegal capped his own salary at $350,000, which is a tiny fraction of the $1 million-plus salaries typical for Fortune 100 CEOs. He left that money in the company to invest it directly back into the workforce. The contrast here is honestly pretty stark. While the average retail worker is making around $17 an hour, often dealing with entirely unpredictable schedules, a Costco employee averages over $26 an hour. And it doesn't stop at wages either. Costco offers generous 401k matching and excellent health benefits, completely defying the standard retail playbook. And this brilliantly illustrates why that upfront investment actually pays off. In the retail industry, employee turnover is notoriously high, averaging around 60%. At Costco, turnover is roughly 8%. Experts point out that companies trying to save a quick buck on low wages end up spending an absolute fortune rehiring, retraining, and dealing with operational mistakes. Paying more upfront actually saves Costco millions of dollars on the back end. The return on investment for these good jobs is profound. Empowered, cross-trained staff essentially build slack into the system. Lines keep moving rapidly, shelves stay fully stocked, and they suffer zero lost sales from frustrated customers. Ultimately, happy, secure employees mean happy, incredibly loyal members. Section 4. Financial Proof of Concept. The numbers behind the empire. Now, a skeptic might look at all this and think it sounds like they're running a charity. But looking at their recent financial metrics, Costco is incredibly efficient. A return on equity of 28.5% and a return on assets of over 11% are fantastic indicators of a company generating high net income from its asset base. But the really wild part is that asset turnover ratio of 3.3 times. That means for every single dollar invested in assets, they are generating over $3 in sales. They pull inventory in, and because of their limited SKUs and high volume, they convert it into cash at lightning speed. So the crucial point is how all this actually translates to the customer. Because remember, their entire model relies on that renewal fee. A standard Gold Star membership costs $65 a year. But the estimated annual savings for a family shopping at Costco compared to conventional retail is between $1,000 and $2,000. That is a value ratio of at least 15 to 1. It makes the choice to renew an absolute financial no-brainer for the consumer. Which brings us to the ultimate mic drop metric of this explainer, 92.7%. That is Costco's membership renewal rate in the US and Canada as of 2023. It is literally one of the highest retention rates in any consumer business on the planet. This single number proves that their counterintuitive system of passing up margin, limiting choice, and paying workers well works perfectly. Costco's runaway success absolutely proves that a business doesn't have to be at war with its customers or its employees to generate massive shareholder value. By making profit a byproduct of delivering relentless value rather than the primary goal of every single transaction, they have built an absolute empire. It leaves us with a pretty provocative thought. Will leaders in other industries ever have the courage to abandon short-term markups and truly align their company's interests with those of their customers? Thanks for joining me on this explainer, and I'll catch you on the next one.